what are the key red flags that you look for, that tell you that either a stock or a sector is something where you'd want to pare down your position? With examples, if you can share, because that's a question that a lot of our audiences have when they're looking at the portfolio. Sometimes they're wondering whether you should sell your winners or sometimes you should sell your losers, because you'll never know what the effect will be in the future of that decision on your portfolio. But what are some of the red flags that you look out for?
I think the first is obviously I'm a very value driven person, and every year you get different sectors which are in value. Like,
Hmm.
say, for example, 3 years back,
Hmm.
IT sector was quoting at 30 XP.
Hmm.
It was not value by any stretch of imagination.
Hmm.
Today, the valuation for the large caps have come to 20.
Hmm.
It is definitely value.
Yeah.
So I think there is a inherent sector rotation which happens every 12 to 18 months, that relatively what is looking better,
Hmm.
whether it is IT, whether it is banking. So banking was looking very attractive 12 months, 18 months back, especially some of the large cap private
Yeah.
sector banks which were going through their own challenges and markets had derated them.
Hmm.
Today, I think large part of the re-rating is over, and I see better opportunities in other sectors, like, for example, IT.
Okay.
So some of the shift has happened from the banking to the IT,
Hmm.
where the opportunities are better.
Hmm.
But just to give a perspective on winners versus losers, I think the real challenge is, from a very psychological perspective, is to get rid of your losers.
Hmm.
Because
Hmm.
the psyche is that I have taken a loss on that, मुझे break even करने दो,
Hmm.
then I will sell it.
Hmm.
But in reality, what happens is that takes a very long time.
Yes, it does.
Sometimes it may never happen.
Yeah.
And then you just have a kind of a bias that let me be an holder. And then you try to convince yourself with a lot of facts saying that nahi, it has just fallen. There is a lot of hope. So for me, that is the biggest thing that I would look out for. So for
Yeah.
every company, I have a thesis. If I find that the thesis has not played out, I don't mind taking that hit and looking for better opportunities.
Yeah.
Selling a winner is always easy
Hmm.
because you've booked your profits. But even there, I think the question that you must ask is that what has led to the gain? If the stock has doubled,
Hmm.
then has the PE doubled or has the earnings doubled?
Yeah.
If the earnings has doubled and the PE remains the same, then selling the stock doesn't make any sense.
Yeah.
But yes, you have your own concentration limits, risk limits, that is fine. But again, the ultimate goal of, I think, any investor
Hmm.
is to hold on to the stock for 10 years, 15 years, make it a 100 bagger,
Yeah.
rather than, searching for a 20% idea every year.
Yeah. That's in fact gets me to one question which I've had with some of the fund managers who've come on this show, and probably is useful for the audience also out there. You know, over the really longer term, what decides your portfolio performance? I'm not talking about alpha or beta, just absolute performance. Finding that 10 bagger or avoiding mistakes, right? Because I know it's a blend and a combination of both. But I've heard a lot of fund managers tell me that, if you just avoid mistakes, in general, that should hold you through. Because finding winners in a market in a country like India, I mean, I'm not saying it's easy, but the chances of you going wrong are slightly less. It is the mistakes that kind of affect performance a lot.
I think in today's environment, yes, I would say it's more on the mistakes. But maybe 10 years back, 15 years back,
Hmm.
finding you would need to have at least one or two multi-baggers or three or four multi-baggers to see you through.
Ah.
But in today's market, I would say yes, definitely avoiding a mistake is probably far, far more important than trying to find that multi-bagger.
Hmm.
So it's a combination of both. But see, the way it works is any fund manager, any investor will make mistakes. It could be 20%, it could be 30. I think the benchmark is probably between say 30 and 40.